Okay, guys, we're going to go to Ask Scruff. Now, this is, I'll have to read between the lines on this. So the question's for Stephen. A little salute to you, my kid. Currently only trading USJPY because my brain can't handle multiple assets. That's not a problem. It's a good way to go. Just remember, you've got to ride it through thick and thin. So if there's nothing there, don't force the trade. That's why sometimes it's nice to have maybe look at 2 or 3 assets, or even just 2, but completely different. Because if you trade sort of like cable and euro dollar at the same time, they move roughly the same. So if one's not ready, the chances are the other one ain't either. So try something different. Maybe it's like sort of pound USD and USJPY. Off track slightly. But it says, if my stop area is about 75 pips away, and you would prefer a 50 pips stop, instead of reducing the size to accommodate the stop, could I enter my first position at madness level 2, 3, and then go for one-on-one anticipating a pullback? Right, this is where I've got to read between the lines. Anticipation is trading what you think. I prefer to trade what I see. Okay, so if I think it's going to do something, I automatically discount it. Okay, now assuming it is going to pull back, which is what you're waiting for the market to relax, I would actually just let the market relax and not try and go to market at all. You know, just let it come back, put a marker on the chart where you would like to enter, and then just wait for the price to go beyond it without an order. Now, another way to do that is you can draw your fib on the current leg of move, say an hourly chart, draw your fib on. We know that if it's a strong directional move, it'll come back to 50% a lot of the time. It'll certainly come back to 38, which means it has to pass through the 23. So put an alert on your 23. When that's triggered, reassess the chart. If you're happy with it, put in your entry criteria and then use your madness points from there. That way, you're now seeing the chart for what it is rather than thinking what it's going to be. 2 different concepts. Now, if you feel that the continuation is going to continue and the pullback is going to be shallow, well, that's when you do have to sort of go, well, I think it's too expensive down to 75 pips. You can half your position to accommodate the stop. But the danger comes if you're looking at a very wide stop like that, and it runs through half an ATR, the chances of it coming back is pretty slim. So you kind of put yourself in front of the freight train. But on the other side of the coin, if you enter the market and you move your stop towards your price, well, you've definitely put yourself in front of the freight train, because we know how far it'll roughly retrace based on the law of Fibonacci. So you've got to be a bit careful. So my advice in this scenario is, let it show its hand. Let it pull back first, then consider going to market, rather than trying to go to market anticipating the pullback. Hope that kind of makes sense. Anyway, if you're stuck, just shout when we're in the live calls and I'll go through it. Catch you soon.